Owning Amazon stock has historically always been a smart decision. However, there are times when owning Amazon is good, but other times when it's fantastic. And now is a great time to start looking into Amazon stock because they just reported their earnings. We've got a fresh update on the business. And when the earnings report came out, they actually beat earnings expectations from the quarter by 26.5%. Out of all the companies worth owning in the stock market, Amazon had the biggest beat that I've seen. Their revenue also beat by 3.4%, also very impressive. And Amazon stock was rewarded with an 8% sell-off. That doesn't really make much sense at face value. Amazon should have gone up 11 to 15%. But to understand why Amazon had such a poor response to their earnings, we need to dive deep into each of the major businesses owned by Amazon. I'm going to go through the different businesses of Amazon just in order of their importance, but also excitement. Starting off, we have the physical stores. So things like bookstores and Whole Foods, anything that Amazon sells in physical locations, that's only growing at 7% per year, 3% of the total revenue. Then we have the online stores. Now that's just Amazon, the website, where they sell their own products. $61 billion in the last quarter, 10% growth. Next, we move on to third-party sellers. Now these are where you sell your own products onto Amazon, you pay a subscription, and then you pay fees based on the volume. Now we're starting to get into the more exciting businesses. Pretty much anything with potential profit margins above 30-40%. Now we have the advertising arm of Amazon. Amazon primarily has two different ads that they typically sell. For example, Prime Video, they're video-based adverts. You get the 30-second ad. And the second type of advert, which is kind of similar to Google search, is where you just get a prioritized listing on Amazon's website. What's really impressive about this is the growth of the business, but also the extremely high profit margins they could likely have in a couple years. Now, we don't quite know those metrics right now. Is the yearly average growth from the first quarter of 2021. I've listed here the top 4 advertising companies or online advertisers. 3 of the most impressive companies in the world are Google, Facebook, and Amazon. And Amazon is actually outgrowing the other 2 big names. In the last 4 years, Amazon has averaged 23% yearly growth of its ad business, whereas Google has only averaged around 13% growth, and Facebook actually being second best at 15% growth. And last up, we have the most impressive business being Amazon Web Services. Now, Amazon Web Services started off as a bit of an experiment about, a decade ago. Now they're actually an extremely mature part of Amazon. Being an absolute money printing machine, Amazon Web Services averages profit margins around the high 30s. In the last quarter, they did drop down in profit margin, which is a little bit disappointing, and where the source of sell-off was when the earnings were announced. The profit margins of Amazon Web Services did drop down from 39% in the first quarter of this year down to 33%, but also the revenue growth stalled out. Definitely much weaker growth than the other 2 major competitors. Google Cloud grew 32% this quarter, Microsoft Azure grew 31%, Amazon Web Services only grew revenue 17.5%. But even after that weak quarter of Amazon Web Services, versus the rest of the business, all the adverts and subscriptions, e-commerce, all of those businesses together, they are still printing less profit than just Amazon Web Services alone. And by looking deeper into the different business segments, we start to see a picture that normally the weaker parts of the business, being all the subscriptions and e-commerce, are actually firing on all cylinders, especially if we consider all of this trade war and tariffs that have been going on. I think Amazon's done a very impressive job. Revenue for North America was up 11% if we average out all those businesses. The operating margin actually increased 48%, an extremely impressive number considering how mature Amazon is as a business. The international arm was even more impressive, 16% revenue growth helped by a weak American dollar. And then we have operating income for international up 448%, mainly helped by really weak operating profit back last year. And by contrasting the Amazon Web Services segment against those traditional arms, we actually had almost the same revenue growth, a little bit stronger, 17%, but the operating income was extremely weak, only growing 9%. And for the Amazon Web Services part of the business, that's a very, very weak growth number. So again, that is scaring off many investors who really hold Amazon Web Services as the crown jewel of Amazon. But if anything, this is telling me the traditional side of the business is booming, going absolutely strong. And if Amazon Web Services has a weak profit margin quarter, that just leaves more room for expansion in future quarters. I see this as a pulled rubber band, saving up all of this profit margin expansion, and they could have a few blowout quarters for the rest of the year. Unfortunately, I do have another negative to show here about Amazon, and that's the story around free cash flow. So we have here the free cash flow is down by 66% compared to last year. Now, when we see where the money is going, pretty much all of it is going to more property and equipment, or in other words, helping expand the Amazon Web Services business and maybe some AI type investments as well. Out of the $121 billion of operating cash flow, cash coming just from the raw business, $103 billion is going to reinvesting into the business, buying up these data centers, and I think they're even making a nuclear power plant. Unfortunately, that was the last of the pretty graphs. We have to get into the boring little earnings report, getting into the numbers in order to get as much information out of that latest earnings report as possible. Going through the income statement in some more detail here, all I'm going to do is show the yearly change numbers that are truly important or just worth mentioning. The revenue was up 13.3% year over year, which is a decent growth for Amazon. Not bad, but not fantastic. Most of the operating expenses are actually growing around 10%, which is less than the revenue growth. So you're always going to see some profit margin expansion on average throughout the business. But we did see one area of expense growing quite strongly, and that would be technology and infrastructure, which is not surprising, growing 21.8% and is likely going to continue marching higher over time, reinvesting into your business. But that also creates expenses in maintaining your facilities and depreciation of your assets over time. Even taking into account that really high technology cost, the operating income still grew 30.7%. And that's really the magic of a company that's got quite low profit margins across the entire business. Amazon Web Services might be pretty good, but the traditional arms are actually quite low profit margin, and that translates to a 32.6% growth in earnings per share. That's all the financial information I wanted to go through today. We're going to finish with, I think, the best part of the video and expressing my real opinions about Amazon stock. But what I've done is plotted the 12-month forward PE ratio, so the stock price divided by the next 12 months of earnings, did that throughout time, and it just goes to show us a really nice picture of a valuation that is good to start buying Amazon stock, and then maybe when we're getting to max valuation. At the moment, we're sitting at a 27.2, and going back into time, that typically is a very good price to start investing in Amazon. Now, when we see maximum valuation, it's around 33, 32 is when I would start getting a bit concerned. If anything, the valuations here are good, but I would not say they are very cheap. Getting down back to a 23, 24 forward P ratio would be a much better place to, get more aggressive in my opinion. However, when showing the update here of the growth on sale portfolio, my public way of tracking the performance of the channel, we've had a huge amount of updates because the market sold off something shocking on Friday. I've had some put options that I held, sold those pretty quickly because I got a 76% return on that straight away. And I dumped all of that money straight into buying a little bit more United Healthcare Group. In this portfolio, I'm just going to hold that for the long term. So double down on that price. I've bought some PayPal, Amazon, and also Lululemon because those companies are getting to the edge of undervalued, especially PayPal, Lululemon, and United Healthcare Group. Some insanely low valuations on those. I'm sure those businesses, being such high quality, could turn things around. Considering you watched the end of the video, I bet you love these videos, love these stock-based videos, but I also come out with some macro-based documentaries. Make sure you subscribe to keep seeing those. I'll see you guys next time. Bye.